All right. So let's do a quick evaluation on our Texas Instruments position. Okay, before we start diving into some of the earnings positions. Okay, so let's think of the description and what we were talking about with F5 earlier when I asked what needs to happen to the stock for us to get to our target profit area in F5. Let's review Texas here real quick. Okay, just want to make sure everybody can see the whiteboard because I'm using that new recording software again today, which we used yesterday, which you guys said was better. Okay, great. So yesterday we sold the Jan 31st 127, 126 put spread for 45 cents. And the stock was 127 and a quarter. Okay, right now, as you can see here, the stock is up about $1 from where we sold the spread. And our put spread's up about a dime. Makes sense, right? Makes sense with what the delta is. So right now, the stock is 128.30 and our spread is 35 cents. Okay. If ideally we want to exit around 22.5 cents, which would be 50% profit, which we look for on our credit spreads. Now, obviously, we can't exit at 22.5. It would be 22 or 23. Where does stock need to be? And I'm going to put the caveat in there that it's today. Okay, Andrew, you say 130. What else? Okay, good. If we just look at the delta, guys, okay, if we just look at the delta is a positive 11. Okay, so our put spread is positive 11 delta. Means that for every dollar the stock moves, if the stock goes up $1, we're going to make theoretically 11 cents. Stock goes down $1, we're going to lose theoretically 11 cents. So, you know, if the stock goes up $1 from here, to 129.30, then the put spread should be worth roughly 24 cents or so, right? Take off 11 cents to where it's trading right now. Now, again, the key to this is I said today, right? Because it's still early in the week. There's, almost 4 full trading days left in the week to go, inclusive of today. But if the stock were here on Friday, not today, the spread would be close to 0 because of the theta decay in there. Make sense? Again, I go through these things so we can be proactive rather than reactive and just kind of know, okay, this is what we're targeting. This is where, we're looking for something to happen to our profitability, to our positions. Okay. Any questions on that? Right? It's really important to know, guys, not just to follow my lead, which is good, but it's really important to know why we're doing something. Not only why we're doing something, but you know what we want to happen. How do we make money? How do we profit? How do we manage our risk if something goes against us? What about time decay, John? Well, Scott, typically on credit spreads, we look for a 50% return. On debit spreads, when we're buying something, we look for about a 70% return. Credit spreads, we look for about a 50% return. So that's just the ballpark of 50%. Well, why would it be zero on Friday, John? Remember, all options at expiration are what? All options at expiration don't have any premium left to them. There's no extrinsic value. So every option, exactly, every option at expiration is either worthless or or it just trades for intrinsic value, meaning that it would be in the money, exercisable, but still doesn't have any premium. So the premium in every option at expiration is zero, whether the option's in the money or out of the money. The premium is zero. Well, the two options we're looking at in our trade, if the stock closed right here at 128.30, both of these options would be out of the money and both would be worth zero. Now, we're not going to let this go until Friday. We are not. Okay. Does that help? John, everybody else, does that help? Awesome. Okay, let me just get this recording put up here, the whiteboard put up here, and then we're going to dive into some of these earnings discussions.